Welcome to Learning Equinox. In our video today on financial literacy, we shall be talking about the various investment options available to us. So far, we've been stressing upon the significance of saving early in life, how important it is to save, and how do we clear our loans early. Now that you have saved, you also need to understand investments. What are these investments and how do you go about making these investments? In our video today, we shall talk about 5 basic investment options. Now, today's video is for those who are at the beginning of the career and who want to start really small. We are not talking about large investments or how do you become really wealthy or for those who have a lot of money to invest and searching for investment options. It's not for all of that. It's for people who have started their career and started to save a little money. So, today we are going to be talking about 5 basic investment options. And yes, do watch it till the end because towards the end we shall also leave you with one more icing to the cake. So keep watching for that extra bonus. If you like the video and find our videos interesting, do give it a thumbs up and share it with your friends and family if you find it useful in any way. In our video today, we shall look at the different investment options from 3 major angles: the liquidity aspect, risk, and the return. Now, for example, if you save some amount in cash, now the cash is lying at home. It's highly liquid. You can utilize it for anything that you want to. But the risk of it getting robbed is high, so it's risky. And the return definitely is negative because it's not going to multiply or grow. It will only lie in your cash box or piggy bank. So we shall look at the different investment options from these 3 angles: the liquidity component, the risk component, and the return. It's important to keep your money invested in any one of the options. Let's look at the first one, a simple savings bank account. Here, you can safely keep your money. Banks offer interest rate on savings account ranging from 3% to 5% on an average, with few private sector banks offering even more. Keeping money in saving bank is safe. There is no restriction on the amount of deposit or withdrawal except for the minimum balance that you need to keep to maintain that account. So it's high on liquidity. Returns, as I mentioned, are low since it offers flexibility in terms of withdrawals at any time, and the risk too is low. How to open a savings bank account? It's simple. Walk into a bank branch near you and request for an account opening form. Fill it up and there you go. Your account is done in whatever is the turnaround time for that particular bank. Now, the second one. The second is a fixed deposit and a recurring deposit. So, fixed deposit, that is FDs and RDs. Fixed deposits are where you fix a certain amount of money and lock in it for a certain period of time with a bank. The bank pays you interest on that fixed amount. Here, remember, it's a time deposit, so it's not very liquid. As say in the savings account, you can withdraw at any given point of time. Here, your FD is blocked till the lock-in period or the tenure. The tenure varies here from few days to a number of years. And interest varies basis the tenure promised. In case of emergency, you may withdraw the money. However, you need to pay a certain amount of premature closure charge, which is like a penalty. So, this is medium on liquidity. It is least risky because towards the end of the tenure, you do have access for your money for sure. That is the principal amount and the return. Whatever return is offered for that period is in your hands. The returns here are low because on an average it's going to give you from 5 to 7% in today's times. Now, let's say you cannot deposit a certain lump sum money, but you can keep aside some money every month. In that case, you can opt for an RD, that's a recurring deposit. This is more like an FD, the interest rates are also somewhat similar. However, the only flexibility that you get is you deposit in small chunks of money every month. Here, if you skip an installment that you promised, you are levied a penalty. So, that's the only charge that gets levied in case of an RD. How to make an FDRD? It's simple. Many banks offer it online on their website where you can go log in and create an FDRD or walk into a bank branch and open an FD or set up an RD. Now coming to the third one, that is a PPF or an EPF. A PPF is an account with certain banks where you can put in some money annually or whenever you want during the entire year. It gives 7 to 8% returns on an average. The tenure is a lock-in of 15 years, means you cannot withdraw from a PPF account for a period of 15 years. EPF on the other hand is for salaried employees. Now the EPF account is where you and your employer feed an equal portion of money, and it again gets locked in till either you retire or leave that job. Both are very low on liquidity because you cannot withdraw for a very long tenure. The return is a bit more or less like the FD, so I can say it's medium return, and it is very less risky since it is backed by the government. Another advantage here is saving in PPF gives you tax benefits. So the amount that you deposit in PPF account is eligible for ATC deduction, which is eligible up to 1.5 lakhs here. How to open a PPF account? To walk into a bank which opens PPF accounts and open one. EPF is handled by your employer and deductions form a part of your salary. The fourth type of investment is investment in the stock market. This means you buy and sell shares. Here, you study the stock market to buy shares. You can invest short term or long term. There is no fixed time frame. However, it's completely left up to you. You can do intraday trading, means buy and sell on the same day and make money. You can invest for short term, means a few days, a few months, like you buy and sell after a few months or a few days. So you can even stay invested long term. You can buy some shares, hold it for a long time, stay invested and sell when the shares grow. So this is more like a marketplace, and thus it's a share market. So where you go and buy and sell. It's all a matter of demand supply. So this is very risky. Here you alone are the decision maker of buying and selling those shares. So you can make money, you can also make losses. So losses are also a possibility. Again, that's where I say it's very risky. In case the share price falls and you do not recover, you stand to lose money. The returns can vary from a small increase to a larger growth. So I can say that the returns are high. It's high on return, it's high on liquidity. Liquidity means every settlement happens on T plus 2 days. So once you sell within a span of 2 to 3 working days, you get your money in your account. So it's highly liquid. Now, since the risk is high, it's important to gain knowledge on the share market or seek advice from a portfolio manager or some qualified person before you invest in the stock markets. How to invest in shares? Open a demat and a trading account with any broking company. Different broking companies levy different rate of brokerage, so check on that and open a demat and trading account and trade on shares. The last fifth option is investment in mutual funds. This is where you invest in small portion. You can do a lump sum investment or a regular SIP, that is systematic investment plan. Mutual funds are managed by fund managers who take care of the portfolio of your investment. They collect small amount from investors in that fund and invest either in debt or equity based fund type. Now, it all depends on what the fund type is that you're investing. So, mutual funds can either be debt based or equity based or a combination of two. The asset management company, that's the fund manager, collects the money from investors in the fund and invests in different instruments. He makes those returns and shells out a portion of those returns to the investors. Yes, since it involves stock markets investments also, it comes under the risk category. However, some amount of it is also in bonds and debt instruments, so it is not all that risky as a share market. So you can call it medium risky. Investment wise, it yields good returns. The returns range between 10 to 14%, so the returns are high as compared to an FD or any other debt instrument. Liquidity is medium since they again have a lock-in tenure of say 1 year, 3 year or 5 years. So only after your tenure is over, you can withdraw that money. In case you withdraw before the tenure, there is an exit load which is somewhat like your FD premature closure charge or a penalty that you need to pay. So in that way, liquidity can be said to be medium. How to invest in mutual funds? Well, check the different mutual funds and you can invest online or through an investment agent or a portfolio manager. Today, there are many online ways of investing in mutual funds of different asset management companies. So far, you saw the 5 different ways in which you can invest your money to get returns. For all of these, you need not have great wealth. Even a small amount of investment can make a huge difference. A little bit of knowledge and understanding about the different instruments can definitely help you save your money for better returns. Now, of course, there are many more instruments like a house property, buying a land, bonds, health insurances, and a lot more. However, we shall be gradually covering each and every one amongst these, even what we have mentioned in today's video, in our upcoming video a bit more in detail. Another important point is do not put all your eggs in one basket. So diversify your investment in different portions of different types of instruments. These are only a few areas where you can start small and save when we say early in life. So this way you can make your money work as hard as you do. Now talking about our bonus point. These all investments make your money grow, but there is one more investment that can actually help you grow. If we talk about people like Bill Gates and Steve Jobs, these are amongst those who scale up by upskilling themselves. They invest in themselves and invest in their company for better returns. They believe in learning and growing. Let us look at a pyramid over here. The first level here is about knowledge. Here I am not referring to formal education of school or college, but practical knowledge about things that you like to do. Strangely, even after investing 18-20 years, a graduate calls himself a fresher. So, where has been the investment in knowledge? It's important to engage in activities that you love to do. It could be anything. It could be coding, digital marketing, art, or even accounts and finance. Encouraging our children to invest time in taking up short courses on topics that they like and do some small job during vacation for a hands-on experience will give them practical exposure and also give them some pocket money. Second level here talks about scaling up, and learning new skill every time at any age in life will help you grow up the pyramid. This will help you understand what you are investing in, and also you can start your own small business. Business helps in saving a lot of money and also expanding your area of skill. Steve Jobs does not talk about anything other than Apple. He innovates with it, he brands it, he grows with it. Get involved in that skill to reap large returns in life. The third level is attitude. Grow with working on your skills that you are best at. This brings in attitude to achieve more and prosper. Remember the video on power of compounding? Now try it with your life. If you learn something and grow 1% every single day in your life, by year end, you will have grown up to 37% in a year. That's the magic of compounding. Invest in yourself, and that is the best investment to grow in life. Hope you like this video. If yes, do subscribe to our channel. In our Financial Literacy every Friday, we shall be discussing on more such educational videos on different topics of finance and money. So keep watching and stay tuned for more.